Hello, everybody, and thank you for joining me for today's webinar brought to you by SprintX. My name is Manis Shortall. I'm the Vice President of Business Development at SprintX Canada. So today's webinar is going to be covering the area of non-resident tax compliance for international students in Canada. So we've called it Navigating Canadian Non-Resident Tax Compliant for International Students, Scholars, and Temporary Foreign Workers. So just before we get started, there are some housekeeping rules as such to go through. First thing is that this recording will be made available tomorrow to each and every one of you guys who's signed up for it. If you think there's any friends or colleagues or fellow students that you think might find this webinar useful, I would encourage you guys to share it with those. You're of course more than welcome to use the chat function here throughout the webinar. If you have any questions, just pop them in the box. We'll have a Q&A towards the end. There is a disclaimer on the right hand side of the screen. So what we say about tax is sort of like it's almost as part of your DNA. So each tax scenario you will find yourself in will be completely unique to yourself and just yourself. So the aim of this presentation is to provide you with a general understanding of tax principles as they apply to non-residents, and as such is for information purposes only. Each individual has a unique tax position and is responsible for their own tax determination and compliance. Also to mention, there are updates from the CRA. They are becoming more increasingly common, especially around CERB and EI payments, and therefore the information represented here may be subject to change. And the last bit for housekeeping is that the feedback is greatly appreciated. So we'll have a couple of polls towards the end, and you can share your thoughts and comments with me. So let's have a quick look at what's going to be covered in today's webinar. So first things first, we'll go through a quick introduction to SprintX Canada, the software that is SprintX, what it does and how it can help you as an international student. Then we're going to look at the basic tax principles for non-residents. This mainly consists of knowing your residency status for tax purposes. So a very fundamental and important part of filing your taxes is knowing your tax residency. So we'll explain how you determine what your residency status is for tax purposes. We'll also look at how different ways in which you can maximize your Canadian tax refund. So this may be through claiming certain tax credits, the basic personal amount, which calculated on your TD1 form. And also there's a new tax credit, the work from home tax credit, which we'll explain in detail a little bit later. We'll also, that falls underneath the basic tax principles for non-residents is understanding the different tax treaties Canada has with the different countries around the world. We'll also go through the COVID-related tax changes. So in particular, we're talking about the CE or B, the C or B, and any EI payments that you received in 2020. We'll talk about the tax implications for any individuals who has received these benefits and how you go about returning or paying the tax owed on these payments back to the CRA. We'll also talk about the eligibility for tax credits, also known as the basic personal amount in Canada. As I mentioned, this is featured on the TD1 form, not the easiest form to navigate, and I guess that's why we're here to talk about the TD1 form and ideally help you guys when it comes to filling it out. And then lastly, we'll have some tax tips that are essentially tips that can touch on each in different areas that we're going to talk about above. Okay, so just looking at the SprintX history. So SprintX is a tax filing software. It's cloud-based. It was founded 7 years ago in the US with the aim of providing an easy-to-use online software to simplify tax preparation and tax filing for non-residents. There's approximately 2 million international students in educational institutions across North America each year. Hence why we've built out this unique software to specifically target international students and to help them with their tax compliance. So in the US, we work with over 550 different partners. Between the US and Canada, we work with over 550 different partners for non-resident professionals, employees, and scholars. SprintX Canada users can easily prepare their tax documents, they can file a non-resident tax return, and you can even secure your tax refund. So SprintX is a part of a wider group of companies that was formerly called the Taxback Group. It's now called the Clune Technology Group, and this group has a range of different companies within it, and each one of them is a world leader in the different spheres in which they operate in. So we have international finance, taxation services, we also have visa issuing company as well, among with global mobility payroll, and also with international money transfer companies. So within the group, the Taxback Group or the Clune Technology Group, we have 20 offices in 23 different countries with approximately 1,400 employees worldwide. So SprintX isn't exactly brand new to Canada. Before SprintX, there was Taxbackcom, and Taxbackcom is also within the Clune Technology Group. We've been operating in Canada since 2011. SprintX Canada has grown from the success of Taxback.com since we landed over here in 2011. And just to bring you back a little bit before that, Taxback.com was established in Dublin in Ireland in 1996. It's a multinational corporation providing global tax refund and return filing services to private and corporate clients. So over the past 20 years, Taxback has filed more than 1 million tax returns and has helped international students, working holidaymakers and non-resident employees in Canada to claim their maximum legal tax refund and remain compliant with the Canadian Revenue Agency. So just an overlook at the Canadian tax system. Very similar to most other countries around the world, Canada has a progressive tax system, meaning the more you earn, the more tax you pay on your income. There are two different tax rates. There's a federal tax rate that applies to everybody within Canada, and then there are provincial tax rates that are specific to the different provinces within Canada. Another important thing to note is that you can go back up to 5 years when filing taxes in Canada. So you may have been an international student in Canada for the last 2 years. However, this may be the first time you're looking at filing your Canadian taxes. Well, not to worry. As I said, you can go back 5 years, and that means if you have a refund due, you can go back those multiple different years to go back filing, and you can receive the tax refund that's due to you. There is a federal tax-free allowance, also known as the basic personal amount. So not every Canadian, either resident or non-resident, is eligible for this amount. It's $13,808 in the year 2021. This amount usually goes up with each year that goes by. So the federal tax-free allowance is great. Essentially, you don't pay tax on the first $13,000 that you earn. However, we will get into detail about how you can find out if you're eligible for this tax-free allowance. This is determined on your TD1 form, which we will discuss a little bit later. Most non-residents in Canada do end up overpaying tax, which results in a tax refund. So the overpayment can come from your income tax, your Canadian pension plan, or also from your employer insurance, also known as EI. So now just a quick overview of the important tax dates within Canada. So the Canadian tax year is similar to the calendar year. It runs from the 1st of January right up until the 31st of December. The tax office usually opens around mid-February for tax filing. That's following the year in which you're filing taxes for. So this year in 2021, the tax office opened on the 22nd of February. This date does change, but usually it stays somewhere around mid-February. So the deadline to receiving your T4 document from your employer is the 28th of February. Your T4 is a summary of all income earned and taxes paid. You receive one T4 for each employer you had in 2020 or in the previous year. So if you had 3 different employers throughout 2020, you will receive 3 different T4s separately at the beginning of 2021 and no later than the 28th of February. So T4 is a very important document. As I said, it lists all the income you've earned from that employer and the taxes you've paid. So this T4 is fundamental. It's a very important document when we are filing our taxes in Canada. So it's important you take good care of it. The most important date on this screen in front of you is the tax filing deadline. Usually it's the April 30th, this year it's April 30th, 2021. Usually it's April 30th. Last year it was pushed out until June due to the coronavirus pandemic. This year in 2021, it remains back as normal, April 30th. So very important that you file your taxes as soon as possible. Essentially, you don't know if you'll have an amount owing to you, i.e. a tax refund, or you don't know if you'll have an amount owing to the Canadian Revenue Agency. So what we best advise you to do is to file your taxes as early as possible. get your assessment, and then you can figure out ways to go from there. So the self-employed tax filing deadline is 15th of June 2021. This is consistently 15th of June for the last number of years. If you have any amounts owing to the CRA in terms of taxes due, you could have had an underpayment of tax throughout the year, and now you're left with a tax bill owing to the CRA. You usually have up until September 1st to pay this bill. In 2021 in particular, you do have up until September 1st. So as I mentioned, taxes are always filed at the beginning of the following tax year. So right now we're in 2021 and we're filing our 2020 taxes. And it won't be until next February when we begin to file our 2021 taxes. So that'll be February 2022, we file our 2021 taxes. Okay, so moving on, we're just going to look at your tax residency. So defining a non-resident for Canadian tax purposes. So before filing your international student tax return, you must determine your Canadian residency status. So failing to do so may cause future complications with Canadian tax authorities. And there are a number of different points to consider when determining your residency status. So first things first is the CRA will make this determination on a case-by-case basis. So they'll look at all the different elements that apply to you and your tax residency, and they'll make a determination on what your residency status is for tax purposes. The main things that CRA will look at are bullet pointed on screen in front of you. So it's the length of time in Canada. If you spend longer than 6 months or 183 days in Canada throughout the calendar year, then what CRA do will move on to the below determining factors to check your residency status. So once you've satisfied the CRA that you've been here for longer than 6 months, you then, the CRA will look at your residential ties in Canada. So your residential ties in Canada can be both primary or secondary. Primary ties include owning a home in Canada, having dependents, and having a spouse or a common law partner. Then secondary residential ties in Canada will be owning, say, furniture, personal property, having a membership to a gym, perhaps you have a car loan, you might have a credit card. Any other social ties to Canada usually fall into the secondary residential ties. Your intent after your Canadian visa expires is closely looked at as well. If it's believed that you will return back to your home country, not stick around in Canada after your studies, then it's most likely you will be considered a non-resident for tax purposes. And also another element to be considered when determining your tax residency status is the tax treaty that may or may not apply between Canada and your country of residence. So Canada has over 150 different tax treaties. We'll touch on them a little bit later, but essentially some tax treaties mean that you can't hold residency status, you can't hold a status of being a resident in more than one country. So what most individuals find themselves doing is dropping their residency in Canada if they were given residency, and therefore maintaining residency in their country where they're from or where they came from. So many students return to their home country on a periodic basis or move to another country when they're between university semesters. In these cases, it's very difficult to establish significant residential ties to Canada. This is due to the fact that you're moving around so heavily. Therefore, these students are typically considered non-residents in Canada. As we said, though, to properly determine your residency status, you must consider the student's intention and whether they plan to settle in Canada after their studies. So the good news here is that in order to make this defining your non-residence or your tax residency for your Canadian residency for tax purposes, it's essentially what SprintX and our software will do. The first points you'll come across when creating an account with SprintX is a very simple questionnaire. From the questions we ask, we can determine what your residency status in Canada is. So you might be wondering why your tax residency status matters. Well, the main differences between non-residents and residents. With residents, you must declare your income earned outside of Canada on your tax return. However, as a non-resident, you won't be taxed on this amount. It'll purely just be used to check if you're eligible for tax credits. So that's the basic personal amount that we touched upon earlier. There is a rule in terms of determining your eligibility for tax credits, and that's called the 90% rule. In short, it means that 90% of your income must have came from Canadian sources throughout the tax year in order to be eligible for tax credits. If less than 90% of your income came from Canadian sources, then unfortunately you're not eligible for tax credits. The difference in residency status between non-residents and residents, just jumping back in here. So with residents, you are asked to declare your income you've earned from outside Canada, and you will also have to pay tax on that amount. So that's the main difference. Non-residents must declare the amount that they've earned outside Canada. However, they don't pay tax on it. It's just used to determine your eligibility for tax credits. Whereas with residents, you will be asked to declare the income you've earned from outside Canada, and you will also be asked to pay taxes on that too. So just looking at your tax filing requirements, international students in Canada should file a tax return if they meet one of the following points below. So to guarantee their compliance with CRA, if you have a tax underpayment throughout the year, you must file your taxes and pay back the amount you have owing in tax. And also you may have a filing requirement if you want to claim your tax refund, or else to use the different tax credits that are made available to you. So if a student fails to comply with their tax filing requirements, they may incur fines or penalties from the CRA. So they may also jeopardize their future Canadian visa applications. As I said, the tax filing deadline is 30th of April each year, so it is best advised to file as early as possible so you can see what the outcome is, and then you can plan your approach from there. The question we get asked quite regularly is, can international students claim a tax refund? Simple answer is yes. The average Taxbackcom tax refund in Canada has been $998 for the last number of years. International students are entitled to claim a number of different tax expenses, including tuition, textbook amounts, interest on student loans, medical expenses, and certain moving expenses. Also, if you're working from home, there are new work from home tax credits available to international students also. So how SprintX helps non-residents in Canada. So in very short, just kind of an overview of the SprintX software, there's two elements to it. There's the tax preparation, which is filing your income tax return, and then there's also the tax determination. So with tax preparation, SprintX tax filing solution is specifically designed to help non-resident students and scholars file a Canadian tax return. What SprintX will do is check if you, as an international student, are eligible for tax treaties, if you're eligible for the basic personal amount, if there's any tax relief from expenses that you may have incurred throughout the tax year, such as tuition and educational expenses. Currently, SprintX is the only online provider to offer Canadian tax filing along with tax determination software for non-residents specifically. The second element to SprintX Canada is the tax determination. So SprintX provides a tax determination software to ensure that non-resident professionals, employees, scholars, and students are taxed correctly on their income coming from Canada. Also to make sure that the correct amount of taxes are withheld from earnings and reported to employers and the Canadian Revenue Agency. So what SprintX, the tax determination software, can do is we can generate tax forms such as your T1, your income tax filing form, your TD1, either your federal or your provincial TD1 form. If you have an individual tax number application, you can do that through SprintX Canada. We'll also help you input information from your T4A, your T4A NR, your tuition and textbook tax credit form, which is the T2202. There's a whole bunch of other forms, including the tax determination software. I just kind of touched on the most popular ones that we see popping up on a regular basis. So what's SprintX TDS? The most important part of it, what we will do is we will determine if you're eligible for the basic personal amount, so that tax-free amount. We'll check this at the beginning of your employment or when you're changing employer. The reason why this is so important to get this right from the get-go is that the TD1 form can quite often be the difference between receiving a tax refund or having an amount owing to the Canadian government. A lot of non-residents in Canada will end up claiming tax credits in Canada when they're not eligible. Therefore, they're asked to repay this amount when it comes to tax filing time. So if with SprintX TDS, what we can do is we can ensure that you're taxed correctly from the beginning of your employment so that there's no nasty surprises in terms of having a large amount of tax owed back to the CRA when it comes to tax filing season. Okay, so now looking at the TD1 form that I've been chatting about the last couple of minutes. So this is the basic personal amount. A lot of people call it the BPA. Some people call it the tax-free allowance. So basically what a TD1 form is, it's used to determine, the form itself is used to determine how much tax to withhold from your earnings, and also to tell the CRA and your employer if you're eligible for tax credits. So it's used to calculate the amount of tax, income tax that will be deducted or withheld from your employment or your pension income. It must be completed by all new employees. That's very important. If you don't fill out your TD1 form, you will be taxed more heavily at a higher percentage until eventually when you do fill out your TD1 form. It's the TD1 form, as I said, it must be completed by all new employees. Very important that if you hold multiple different employers, or if you have more than one job, you must only complete the TD1 form for one employer, and you can only claim the tax credits for one employer. So unfortunately, you can't claim the tax credits with two different employers. If you do so, you'll have a massive underpayment in tax. There'll be a couple of nasty surprises when you come to the tax filing season at the end of the year. So there is in Canada this tax-free allowance, or the basic personal amount. So essentially it allows an individual to earn $13,808 without paying tax. So as I said, this $13,000 amount, this goes up each year, or it has done over the last number of years, and it's expected or forecasted to increase with each year that goes by. So like I said, not everyone's eligible for the amount, which is $13,808 tax-free. As a non-resident, you must take extra care when reading the TD1 form. It's important that you read the second page first and then move on to the first page. What the TD1 form, or what CRA wants to see on the TD1 form, is a section that's dedicated to non-residents in the second page, and essentially asks, in the specific tax year that you're filing for, will 90% or more of your income come from Canadian sources? So if 90% or more of your income comes from Canadian sources, then great news, you are eligible for the tax credits, and you can fill out your TD1 form accordingly. However, if less than 90% of your income came from Canadian sources, unfortunately, you are not eligible for the tax credits, and you must put a 0 in box 13 of the first page of your TD1 form. Now, if you are having difficulty with your TD1 form, again, it's another great part of the service that the SprintX software it's just launched, that we have the TD1 calculator as such. It's tax determination software where we can send back to the individual users their pre-populated TD1 forms to ensure that they're claiming or not claiming the tax credits where there is eligibility, and to make sure that they're taxed at the correct amount from their employer. So there's two types of TD1 forms. There's a provincial and a federal TD1 form. Mainly, most people just need to fill out the federal TD1 form if on line 13 you have a claim amount that's higher than the basic personal amount, which is the $13,000 figure. So if your claim on line 13 is more than the $13,000 figure, you will be asked to fill out a provincial TD1 form also. And one of the most important points is that if you don't receive a TD1 form, you can request one directly from your employer. Ultimately, it will be you as the employee that will be receiving the backlash if you don't have a TD1 form filled out, or if you wrongly claimed tax credits. So at the end of the day, it's your responsibility to ask for the TD1 form directly from your employer. So moving on to the T2202 form, and also the Schedule 11. They sort of go hand in hand. So the T2202 is a tuition and tax credit form, and the Schedule 11 is the accompanying form that you need to complete in order to determine how much tax relief you can receive off the back of your tuition payments. So a T2202 is issued to all students who paid tuition and fees for qualifying courses and that are eligible for claim on the income tax return. So the fees must be more than $100 in order to receive T2202 and to claim the eligible tax credits. You must have paid fees in excess of 100 Canadian dollars. So the T2202 includes the maximum student tax deductions for tuition, education, and textbook amounts. SprintX software will determine whether a student is eligible for these tax credits on a personal income tax return based on their individual circumstances. SprintX will also use this non-refundable tax credit to offset part of the expense of college or university by reducing any tax the student may have owing. Also, SprintX recommends filing your personal tax return on Schedule 11, even if you have no tax to pay. So even if you didn't have any income or if you didn't have any employers throughout the tax year, it's still best recommended to file your tax return with your Schedule 11. So to make sure that you are transferring part of your current year's federal tuition fees, or if you have an applicable provincial and territorial tuition, education and textbook amounts, so that we can update your tax account with the amounts of unused credits available to be carried forward to future years. So even if you don't have a tax refund or amount owing, you can carry forward your tuition to tax credits into the following year. So looking at double taxation agreements and tax treaties. So in particular, this is focusing on non-residents in Canada and how that non-residents in Canada may have a tax treaty between Canada and their country of residence. So Canada has over 150 tax treaties with different countries worldwide. A tax treaty is an agreement between countries that is intended to resolve issues of double taxation and tax evasion. Tax treaties usually outline not only the taxes that are to be paid, but also whether or not a person is considered a resident and thus eligible to the benefits of the country under their tax system. So this point is something I touched on earlier, whereby a lot of individuals will have a tax treaty between Canada and their home country, and it means that they can't hold residency in two countries. So what we see is most commonly done is that international students will adopt a non-resident status in Canada in order to maintain a resident status of their home country, whether that's in the UK, India, Australia. The tax treaties also list any special circumstances or exemptions where the income of an individual who is a resident in one country will be taxed in another country. So the double taxation agreements are there to make sure that you're not paying tax twice on the same income, whether that income comes from outside of Canada or inside of Canada. What SprintX will do, we will automatically apply any of the tax treaties and the double taxation agreements that are applicable to you and your home country. So there's been quite a few changes to the tax year in 2021. This is most commonly just off the back of COVID-19 and the different changes we saw happen or unfold in the year 2020, and then what this means for the tax year in 2021. So as most of you are probably aware, there was a number of different benefits that were eligible to anybody, whether you are a resident or a non-resident in Canada throughout 2020, and there's still some benefits available today in 2021. So the main benefits we saw were the CERB, the CORB, and EI benefits. So I'll just chat a little bit about the differences between CEORB, the CORB, and EI. So with CEORB, there is no tax withheld from the source. So that means you could earn up to a total of 14,000 Canadian dollars without paying any tax or having tax withheld. Now, this income you received in terms of CEORB is taxable income, and you will be asked to include this in your tax return for 2021. So you need to list it as income received in the year 2020. You will also receive a T4A or also possibly a T4E statement. This will have the amount or the amount of benefits that you received in 2020 listed on it. The government have given a deadline of March 11th, 2021 in order as the last date in order to receive your T4A or your T4E. You can also get access to your T4A on your My Services account on the CRA website. And as I said, you need to include your CEORB payments in your tax return as income earned in 2020. Now, if we look at the CORB, unlike the CEORB, where there was no tax withheld, with the CORB, there was 10% withheld at source, which is good news for taxpayers. It just means that the amount of tax you need to pay back on the CORB amounts will be significantly less than the CEORB. So there was 10% withheld from source. Just like the CEORB, you will also receive a T4A or a T4E statement from the CRA or from Services Canada. You can also log into your CRA account to receive those forms. Just like the CEORB, you'll need to include your 2020 CORB payments in your tax return as income earned in the year 2020. So overall, there's less tax owed on the CORB and also with EI payments when compared to CEORB. So the information on the screen for CORB is literally the same for the employment insurance benefits, the EI benefits. So there is also 10% withheld from source when it comes to EI, meaning you'll have less tax owed on EI and CORB payments compared to CEORB. So the tax implications for the CERB, the CRB, and also the EI benefits. So the CRA, for example, if you receive the maximum amount of CERB, you're looking at receiving 14,000 Canadian dollars. So the CRA will add $14,000 to your 2020 taxable income, on which both federal and provincial income tax will be applied. Now, I know not everyone has received the full amount. This is just for example purposes. You can use your tax refund. So when you file your taxes, if it's found that you have an underpayment or an overpayment of tax and you're due a tax refund, you can use this tax refund to offset against any of the tax owing on your benefits received in 2020. And there are also other ways in terms of lowering your tax bill or offsetting certain tax credits against your tax bill, and we'll get into those a little bit further. The good news is, though, if you do have an amount owing in terms of taxes to the CRA, it's important not to panic. The CRA are very accommodating, especially we had a year last year like no other, and similarly 2021 hasn't been similar to any other years in recent history. So the CRA are being very accommodating, and there's individual arrangements made in terms of paying back taxes, and this is based on your own individual ability to pay. So we also saw a new work from home tax credit become available in 2021. One of the changes we saw. So there's now two different methods in terms of claiming the work from home tax credit. So there's the new simplified process that was released or that was announced in late 2020. The reason they brought out this new simplified work from home tax credit is because it's now made available to way more people than ever before. So as Canadians are increasingly working from home due to COVID, understandably, the tax credit is now a lot more people are eligible for the tax credit than before. So in order to be eligible for this new simplified process of the work from home tax credit, you must have worked from home for more than 50% of the year. So more than 50% of your time over a period of at least 4 consecutive weeks in 2020 due to COVID-19. So the amount you can claim is $2 per day up to a maximum of $400. So that's $2 per working day up to a maximum of $400. The great news is that with the simplified process, you don't need any additional forms filled out by employers. You don't need any sign-offs or anything of the sorts. Now, there is the more traditional detailed process in terms of claiming a work from home tax credit. This has been in place for the last number of years. And the difference is that you can include a wider range of expenses, such as your desk, your chair, Wi-Fi, heat, stationery, maybe you have to buy a new laptop. So we see a lot of people go back to the traditional detailed process in terms of claiming work from home tax credit when they have more than $400 in tax relief to claim. So if you estimate your expenses from working from home to be in excess of $400, then it's advised you go with the detailed process. Now, in saying that, the detailed process means that you must have approval from your employer, and that's their approval must be given and signed off on a form called the T2200. Or in some instances, it's called T2200S. So as I said, this both must be completed and signed by your employer. Actually, just to go back to the work from home tax credit, this is another important tax credit you can use to offset against any tax you have owing to the CRA. So if you receive CERB and you have maybe $2,000 or $3,000 in terms of a payment on the tax element of your CERB payments, you can use this $400 work from home tax credit. Once you're eligible for it, you can use the $400 to reduce the amount of tax you have owing to the CRA. Similarly, with the basic personal amount on the TD1 form, you can also use your unused tax credits to reduce your tax liability. Okay, so just finishing up with some tax tips. So there's a couple of different tax tips here. They're spread out and kind of applicable to all the different areas that we covered on the webinar today. So if you're entitled to personal tax credits, i.e. the basic personal amount that's determined on the TD1 form, you should only claim them for one job. So if you're working 2 employers, it's important that you only claim the tax credits for one job. And coming from the kind of tax specialists, we would recommend claiming tax credits for the employer that pays you the most. Also, when starting a new employment, as we said, you need to complete your TD1 form, but it's best advised to complete it as soon as possible. Reason being is you will be taxed at a higher percentage, and the percentage increases the later you are in terms of handing in your completed TD1 form. Now you can receive this, the higher tax you pay, you receive this back in terms of a tax refund, but to kind of save the hassle and the headache of having increasing tax rates put on your new employer's income, then we suggest you fill out your TD1 form as soon as possible. If you are working in a job that you receive tips, it's always best advised to check with your employer if any deductions for tips have been included on your T4. This is uncommon, but it does happen. We find that some employers will include tips on the T4 form, and in terms of finding out if this is happening to you, we quite simply just have to say go back to your employer and ask to check if your T4 form has included any tax deductions for tips. So the work from home tax credit that we touched upon in the last slide, I would also ask you guys to check with your employer beforehand if they will sign off on your T2202 form. If they are willing to sign off on your tax form and you think that your work from home expenses are in excess of $400, then I would suggest going for the more detailed or traditional, more detailed process in terms of claiming work from home tax credits. Also, there are increasing number of scams going around from either Services Canada, Canadian Revenue Agency, especially now when it comes to the CERB payments. There's a lot of uncertainty, people have a lot of questions and are generally quite fearful when it comes to paying back tax amounts. There are increasing number of scams, so I will ask everyone to be extra vigilant, to report any scams you may have come across, and also if you're unsure, to directly get in contact with the CRA to check if they were looking to get in contact with you. And lastly, best advised to get your taxes done as quick as possible. So the sooner you file your tax return, you can find out if you have an amount owing to the CRA or quite possibly you have a tax refund due. If on the off chance you have taxes owing to the CRA, the earlier you file your taxes, it means you have more time in terms of working out a repayment plan to the CRA and you can get your taxes in order. I'll just say thanks very much for everyone for tuning into this webinar. Greatly appreciate it. If you have any questions, you can forward them on to myself. Email address is up there on the screen. It's info@sprinttax.ca. If you have any urgent queries, you can reach me on my mobile number, which is also listed there below. And once again, I just want to say thanks to everybody for joining the webinar. If you have any questions you don't want to put in the chat box, you can email me directly. And also you can send me your feedback. If there is anything you want more clarification on, feel free to send me either questions via the chat box, or you can pop them into my email mailbox if they're a little bit more personal. Okay, thanks everybody.